In this video, you'll learn how to get out of credit card debt even faster than Dave Ramsey himself without living on beans and rice and living like you're poor, selling off everything you own. Everything is right here in writing, so let's get started. For the best information on the infinite banking concept, living debt-free and retiring with a tax-free retirement program, make sure you subscribe to my channel and like this video. Make sure you don't forget to click the bell so that way you'll be notified whenever I upload new videos. Now let's get on with our program. Are you making only the minimum payments? Are you making $100 extra payment on your Visa card a month and then $150 on your Discover card? Why are you doing that, and is there consistency? Do you have other funds that are in your budget that you're already spending? It's just money that isn't being utilized to its best advantage. So one of the things that I pride myself in that I can provide how we can make that work for you. And I'll be able to put it down in a spreadsheet similar to what we're going to see here. But more importantly, it's going to show you exactly the amount of money and exactly what month you will pay each individual debt off, even your mortgage and student loan debt, if that's you. After this video, there's going to be a link below in the description where you can actually get a free consultation where I'll go through a step-by-step process with you using your current debts and what it could look like for you, your business, or your family. Now, before I can take anybody on a path from point A to point B, we have to take a look at where they are today. So we want to start a look at their real debt report. The real debt report is going to show us more than just what is our balance, but how much are we going to pay in interest? How long is it going to take us to pay that debt? What is our interest rate? And what is our current monthly payment? This way we can better strategize when I look at the big picture of where's their money coming in, where's their money going out, and how can we use our money that's most effective. So if we categorize all of our debts from the lowest balance to highest balance, when you look at the far left next to the description, the principal, the Visa card's $2,589, the furniture's $4,000, so on and so forth. So we're going to start making payments on the Visa until that's paid off, and then we're going to apply that $65 once Visa's off and add that to what we are sending to pay the furniture payment for the $123. Once those two paid off, we're going to take the $65 that we used to send to Visa along with the money that we used to send to the company for the furniture, the $123, and that's $180.62. We're going to send that in addition to the $120.27 to MasterCard. And if we continue to snowball or pay that debt and apply it to the car payment, we can continually go on and apply it to the mortgage. Now, if you look from going from almost 30 years to pay that mortgage off, it's actually 29.6 years. They've been able to snowball their debt to get out of debt in 13.17 years. Now again, this is simply using the principles that Dave Ramsey talks about by snowballing debt. This all looks good so far, but I'll show you that there's a better way. But for now, let's just continue as if Dave and Bonnie were following Dave Ramsey's advice. In just a little over 13 years, or in other words, half the amount of time that they would have had to have their mortgage paid off, they would have paid off all of their debt and be debt-free, giving them $1,978 of liquid cash that now is kind of strapped paying for bills. Well, let's say, for example, they just put that money into a savings or an investment. Now, those are two separate things that I'll go into another video, the difference between saving money and investing money. But for right now, let's just say that they put that money into a vehicle that gave them a 4% return over that 16.43 years. Now, that's a huge difference for Dave and Bonnie if they follow Dave Ramsey's advice. When you look at their situation now, they'd be almost 30 years before they were out of debt. And by following this strategy, they'd be out of debt in just a little over 13 years. And if they continue to put that same amount of money, in other words, like Dave Ramsey talks about, live on beans and rice, don't buy anything, cut up your credit cards, don't spend any more money, and didn't buy anything else for that 13 years, they'd have over $550,000. Now, hey, if Dave and Bonnie followed Dave Ramsey's advice and they had over $500,000 saved over and above whatever other programs they have, that's great. I don't have any problem with them saving over $500,000. The question is there any problem with this game plan? Is there anything wrong with this game plan? Mike Tyson had a saying, people always have a plan until they get punched in the face. So what's your game plan when life punches you in the face? Depending on your age and your life experiences, we know for a fact that we've either just left a crisis, we're either in the middle of a crisis, or we're heading into a crisis. We all know, and again, according to your religious beliefs or personal beliefs, that the storms of life will happen. Life happens to all of us, right? Our car breaks down. There's additional expense. There's a leak in the roof, or the furnace goes out that we didn't anticipate, or they didn't find that in the home inspection. Things will come up. People get laid off. People get fired. People start a business and things don't work out of the way they planned. We all know that at one time or another, your income could fluctuate. It could go down. Now, Dave Ramsey, if you're a Dave Ramsey fan, don't take this the wrong way, because we know that the first step in baby steps is saving $1,000. So to be fair, let's look further into what Dave Ramsey's baby steps are. Step 2 is to use the snowball method, which we're looking at right now, to get you out of debt. Step 3 is save an emergency fund equal to 3 to 6 months of your expenses. So how many people make it all the way to step 3 with only $1,000 when life happens? Well, let's look at what else Dave has on his website. Dave Ramsey quotes Forbes as saying, Forbes recently reported that workers who don't have an emergency fund are 6 times more likely to take out a loan against their 401ks in emergency. Back in 2008, when the unemployment rate began to spike, 46% of workers who lost their jobs cashed out their 401k accounts altogether. He puts this in bold on his website, this first sentence. Your emergency fund acts as a shield to protect your retirement savings when tough times strike. So was $1,000 enough for those people, or even 3 to 6 months? Well, I can contend that there's one issue that's the big elephant in the room that nobody wants to talk about. It's that 50% of Americans, give or take, for the last decades, end in divorce. The average cost of divorce is $15,000. 50% of children that grow up with divorced parents watch a parent or both of them become divorced again. And again, this breaks my heart, and I know that I never thought I would ever get divorced. It's a horrible experience. But Focus on the Family said that 50% of Americans argue about money more than 2 to 3 times a week. So if you're a married couple and you're arguing over money already, you're kind of those people that are in the crisis. So if you make it past that 7-year itch and you're one of the 50%, is that still going to be enough if there's not a death, a medical emergency, or a financial emergency in that 13-year period of time? Are you going to have funds set aside to take a time out and for you and your spouse to go on a retreat? You and your spouse invest time in your marriage rather than you working overtime. Whether you taking those extra projects at work, putting in those extra hours, isn't it make more sense that we plan if 50% of the people are in that situation, that we should have a plan for more than 3 months? Now, I know that's, again, something that's troublesome. And if you're a single person and never have a plan to become engaged or get married, have children, then this may not be for you. But one thing that Infinite Family Banking has a part of that system is we find other money that's already in your budget to help you make sure that you have that extra cushion. Now, I'm not talking about just setting up an extra savings account at your bank. You should have more than 3 to 6 months of emergency funds. But by having a program through Infinite Family Banking, that allows you that choice that when those problems come, you have liquid assets. Now, as I go over this other example with Dave and Bonnie, keep in mind that every individual, every family, and every business, because this can be used for business as well as personal use, all of their situations are different. And the one thing I think we all know is when you start talking to people about budgeting, it's not a happy place. Most people hate budgeting, hate being on a budget. And the reason why a lot of people have a budget is that they can't control their impulse to make purchases. So what we're looking at here is doing it in reverse. We're not looking at what are the things that you can't have and backing you in the corner. What we're going to look at is what freedoms can you have? Because saving is future spending. It's spending money that you're going to have and have the freedom to in the future. So let's take a look at this example of the funds, and I go through an exercise with people to find money in their budget that they really didn't know they had. In this example, Dave and Bonnie had $900 a month that was already in their budget and was just being allocated in a way that wasn't benefiting them. Even Dave Ramsey agrees. If you're paying 18, 19, 25% interest, that's compound interest, how in the world are you going to get ahead if you're only getting 6, 8, 10, or even 12% in the stock market? The stock market, your growth, remember, you have to pay taxes on that in the future. So for a temporary period of time, put a pause on what you're putting for retirement investments in your 401ks, and as well as any other funds that we could find in your budget, which we go through exercises with you. Another area that we find funds that are already being spent every single month is your life insurance. If you don't know it already, Infinite Family Banking in the infinite banking concept uses whole life permanent insurance to be used as a storage facility to put your cash value until you're ready to use it. How we snowball the debt is a little different. After we pay off the Visa, instead of sending the $65 to go towards a furniture payment, we're going to put that into your own banking policy to grow compound interest. So when you look to the top right-hand corner, the furniture bill will be paid off in 7 months by taking a loan out of your own banking insurance policy. After you've paid off the furniture payment and the Visa, now we take that $65 that used to go to Visa, put that monthly into your banking policy. We no longer have the furniture payment for the $123.62. So those funds every month will also go into your banking policy. Once you've had enough in there, which is only in a couple more months, in 10 months, you'll have that MasterCard paid off by taking a loan out of your policy. Now you'll be putting, as you see to the right, after you pay the MasterCard off, you'll have $1,088.62 that is now compounding interest into your own banking system. So let me ask you a question. If you didn't utilize this banking system and you just used, as Dave Ramsey or other financial advisors would recommend, that you keep that 3 months emergency fund in a checking savings account or sitting in your safe earning no interest or next to no interest, is that really being a good steward or a wise manager of your money? Think about it. If you've got cash sitting in envelopes or sitting under your mattress and inflation is at, let's even say, 2 or 3%, you're losing 2 to 3% of that money. you're guaranteed to lose money. Now, obviously, we need to have quick cash, but this is a system that allows you to have a moment's notice of those funds. And what's even better, you actually gain 4% interest plus compounded, and you never ever pay taxes on any of the growth ever. Now, because we only utilize mutual whole life insurance companies, meaning they're going to pay dividends over and above the 4%, but we never use those in any of our illustrations because it's not guaranteed. But just have the peace of mind of knowing that this is a contract with a company that's over 100 years old. So getting close to the Civil War era is how long they've been able to be financially successful year after year, and in over 100 years, they've never not paid dividends. So through all the depressions, recessions, they've been able to find a way to make money and still be solvent. So how does that make you feel knowing that you've got that additional funds coming in? And if you just use that same amount of money that's in the budget, like Dave and Bonnie, they would be able to have $1.2 million in that same 29.6 years. Let's take a step back and look at this. I like to break this down to the ridiculous. If we divided that 1.2 million over the 29.6 years, that would be equivalent of you making or saving $40,000 a year tax-free in addition to dividends that you'd receive. That's the equivalent of day one starting this program of saving $3,386.23 a month every month from the very first day you started your savings program all the way to 29.6 years. I like to break that down and show that to people so they can understand and grasp how much of a dramatic difference that's making in their life. Now, some people might ask, do they really have $1.2 million after 30 years? Well, that depends. Do you think Dave and Bonnie are going to purchase anything else in the next 30 years? Well, of course they will. And so will you. Do you think with $1.2 million that they could purchase a lot of things and have an awesome retirement? Well, I'm sure that they should. Let me ask you a question. If you had an additional $1.2 million, and again, this is guaranteed return over that 29.6 years, do you think if you saw an investment for whether it's real estate, precious metals, or you did see a stock that you wanted to take a gamble with and invest hoping that it would go up rather than go down? So let's look at those last four lines, shall we? You see the line that says accelerator amount $900. As a review, the accelerator amount, that $900, are the funds that are running through their own personal banking system and their whole life insurance policy. Now, some people might say, you know, Mike, I can get a lot better return in the stock market through my 401k or other means than 4%. Well, let's take a look at what that did for them, because what happens isn't just what goes on inside the policy, meaning the 4%, but it's what goes on outside the policy in addition to the 4% guaranteed return. If you'd like a 100% free consultation and have me personally give you a written game plan on how we can take you from in debt to 100% debt-free, including your mortgage and student loans, in 9 years or less, and it's not going to cost you any more money than what's already in your budget, click the link in the description below, and I'll have a personal consultation and game plan set up for you. If this added value to your life, or you felt this was good content, please like, subscribe, share, and don't forget to hit the bell so that way you'll be alerted every time I upload new videos. In the comments section below, let me know what was the most intriguing part or what was the most surprising and how this was different from other programs you've seen on how to pay off credit card debt. God bless and have a great day.